This is Neil Portis from Tailored Partners. I work as a freelance CFO for growth companies, and this video is for startup founders and SME business owners to show them how to build a financial forecast and set investor expectations for their first fundraise. I'm going to walk you through my 1-5-10 framework. Let's dive in.
Okay, the 1-5-10 in my framework refers to year 1, year 5, and year 10 of the forecast. Starting with year 1, I call this keep it achievable. I think the key here is to make the year 1 forecast something you're confident you can achieve, because you don't want investors to be disappointed right out of the gate. There are always unforeseen challenges right after a fundraise, so give yourself margin. Investors will focus more on the year 5 numbers where they are looking for their return, and we'll touch on that shortly. But I've seen forecasts that are best case and frankly too optimistic in the first year, which led to investors being disappointed right from the start and the company's founders playing catch up from the get-go. So focus your investors' attention on the year 5 forecast and give yourself something you can achieve in year 1. Okay, before we get to the year 5 forecast, let's look at years 2 to 3, and I call this demonstrate scale. This is the bridge from the Achievable year 1 forecast to the year 5 forecast that will deliver on what your investors want. And the key to this section is that the model should show how the business will scale here. For example, how user acquisition will accelerate or economies of scale will develop. Know the key metrics that you'll want investors to focus on and let those be the ones that you benchmark against. Pick measurable ones which show business performance. Not too many though, to keep the messaging as simple as possible. Next is year 5, which is the most important part. I call this deliver results. This is the time frame when investors will be looking to realize their return. Here it's vital that you research and understand who your target investor is and know what return they'll be seeking and when they'll want that return. For example, a private equity investor who invests in more established businesses may be seeking a 3 times return in 5 years on their investment, while a venture capital investor whose investments in startups are riskier may be looking for a higher 10 times return, since they'll need to balance out the zeros they get on their startups that fail. Your model needs to show how your business will get to your target investor's level of return. If your business won't get there, it's going to be tough to gain traction with those investors. Also, you see it actually says year 5 plus or minus 1 to 2 years. Depending on your type or stage of company, an investor may be looking to realize their return as early as year 3 or as late as year 7. And of course, some projects, an infrastructure project, for example, may fall outside of this time window, but 5 years plus or minus a year or two is generally what I see the most. One more thing I want to add here about setting expectations, and that is don't overpromise. I think you want to show a return that meets but is not significantly higher than your investor's target return. You might think the more the better. However, if you set a high bar, you'll have to live up to those expectations later on. Remember that investors are investing for other reasons too, such as a great team or product. If your business can demonstrate their target return in the right time frame, I think you have shown what you need to right now. If you think there is significant upside to their target return and you want to highlight that, perhaps speak to upside levers or potential that's not incorporated in the model but available to the business. Finally, let's look at year 10. I call this change the world, and this is the huge vision for the business. Some investors may want to get a sense for how big the business could get, especially for a startup. And this is where your business will change the world and what those numbers would look like. I wouldn't try to show this in the year 5 numbers. Again, don't overpromise. Your model doesn't need to go out this far to year 10, but rather I would have a metric or two to speak to, perhaps a revenue, sales, or number of users that you can aspirationally believe you can reach. Okay, let's put all this into a quick example. Let's say you're launching a store to sell electric bikes, which are gaining popularity, and you want to launch by raising $500,000 and a $4 million post-money valuation, which yields a 12.5% ownership stake for an investor or investor group who we'll call Investor A. For year 1, let's keep it achievable. You forecast one small size format store with revenues of $150,000. That's 300 bikes sold for $500 each, less than a bike a day. An upside lever here to speak to could be that only bike sales are shown, so any accessory sales, such as helmets, will offer upside potential to your numbers. Looking ahead at the end of year 1, you expect that you'll need to raise again to fund growth. You forecast needing to raise $1 million at 18 months on a $6 million post-money valuation, which is an 8 times multiple on year 3 forward revenues of $750,000. Investor A is not expected to participate in this round and is diluted to a 10.4% ownership stake. Looking at the forecast in this period, in year 2, you are still just operating one small size store with revenues forecasted to be $300,000. That's 100% year-over-year growth, 600 bikes sold for $500 each, and metrics that you could show scale with could be strong revenue growth, customer growth, and cash flow break even at the end of the year. Looking at year 3, you've used that new capital to expand your one store to a larger size store, which will generate revenues of $750,000. That's 150% year-over-year growth, 1,500 bikes sold for $500 each. Metrics showing scale could be accelerating revenue growth, new customer acquisition, and being cash flow positive for the full year. Year 4 is when we plan to deliver results. At the start of year 4, you expect that you'll need to raise again to fund continued growth. You expect that you'll need to raise $2.5 million at the start of year 4 on a $16 million post-money valuation, which is an 8 times multiple on the year 4 revenues of $2 million. You expect investor A not to participate again and be diluted down to an 8.8% ownership stake. For year 4, you've used your capital to expand to 2 stores, both at the larger expanded size with a combined total revenue forecast of $2 million. That's 167% year-over-year growth, 4,000 bikes sold for $500 each. Now, revenue growth is driven by volume, not price in your model, so an upside lever available to speak to would be that you can raise prices. Investor A's 8.8% ownership stake is worth $1.4 million, yielding a 41% return on their $500,000 investment, right in line with the 40% return your research shows that they'll be seeking after 3 years of operations. Finally, for the investor who wants to see how big this can get, you can speak to the long-term 10-year growth plan, the huge vision that you have for the company, where you'll be operating in 3 states by then: New York, California, and Texas, which all have 11 cities with 1 million plus people. You expect that your branding, locations, people, and product strength will create the market-leading position, and you'll be operating 15 stores at that time with a revenue forecast of $25 million, which you believe will expand your multiple to 10x, yielding a $250 million valuation.